to be covering what is a real estate investment trust and the different types of real estate investment trusts available in the Canadian market, and do a quick economic analysis on the different types of REITs available and which ones would meet your personal risk-reward ratio criteria or your risk appetite. So investing in income-generating real estate can be a great way to increase your net worth, but for many people, investing in real estate, particularly commercial real estate, is simply out of reach financially. But what if you could pool your resources with other small investors and invest in a large-scale commercial real estate as a group? So that's what REITs allow you to do. So REIT stands for Real Estate Investment Trust, and is sometimes called real estate stock. Essentially, REITs are corporations that own and manage a portfolio of real estate properties and mortgages. So anyone can buy shares in a publicly traded REIT. They offer benefits of real estate ownership without the headaches or expense of being a landlord. So investing in some types of REITs also provides some important advantages, such as liquidity and diversity. So unlike actual real estate property, these shares can be quickly and easily sold on the equity markets. And because you're investing in portfolio properties rather than a single building, you face less financial risk. So there are many different types of property that an REIT can hold in its portfolio, and the type of property chosen impacts the risks and returns to its investors. Property types that are more susceptible to market cycles, such as retail and hotel properties, should provide higher returns, but the stability of those returns can be affected by short-term changes in the market. So let's start with hotels. Hotels tend to offer the highest yields, but at the same time they offer the highest risk due to the short-term nature of their income stream and the impact of cyclical fluctuations in consumer confidence and consumer spending. So hotels can suffer greatly if occupancy rates drop, and if there's a sustained drop in occupancy, that's going to put downward pressure on room rates, room prices, which is directly influenced by short-term fluctuations in the economy, and investors will see that reflected in the income and cash flow of the REIT, which impacts the cash available for distributions to unit holders. So retail properties are next. Retail properties tend to be more stable than hotels, but if a significant downward trend occurred in the economy and was reflected in consumer spending and consumer confidence, that downturn would impact the ability of retail tenants to maintain and meet their lease obligations. This would be further exacerbated if the rent earned from such a tenant is tied to the sales of the leasee, such as percentage rents, particularly in airports or kiosks in malls. However, if consumer spending turns out to be more bullish than expected, retail REIT could earn significantly higher returns than, say, fixed rental properties. So office and industrial properties are less sensitive to short-term changes in the economy, largely due to the long-term nature of their rental agreements. Tenants in these types of properties are less prone to move to another location at expiry of their lease, so as long as the landlord satisfies the tenant's demands during that lease. Good management ensures lease expirations are spread out, such that generally no more than 15% of the REIT portfolio would mature in any given year. So also the amount of space rented to any one tenant or group is also typically controlled, so that in the event a vacancy or bankruptcy occurs or an expiry of the lease, the vacant space is unlikely to have a significant impact on the overall rental stream, and therefore will not have a material adverse impact on distributions to shareholders. This makes this office and industrial REITs a lot less risky of an investment than retail or hotels REITs. Then there's also apartment and retirement REITs, and these are viewed as the most stable as they are least sensitive to economic cycles. So the portfolio of tenants tends to be more stable. Percentage of space occupied by any single tenant is considerably smaller than that of a retail or office tenant. There are no anchor tenants, and a tenant in an apartment or retirement home is unlikely to abandon their lease simply due to small fluctuations in the economy. So the increased stability of this segment of the REIT sector is reflected by a higher unit price per share and hence a lower yield, often below the 10% single-digit yields you'll find in residential REITs. So this class is favored by defensive or risk-averse investors. So some REITs believe that a diversified portfolio consisting of retail, office, and industrial properties provides the investor with greater stability, while at the same time offering the potential for growth. Each REIT seeks to capture for itself a market niche and a strong following from its investors. Another thing to touch on is development properties or new construction projects. These development projects typically have difficulty in gaining market appeal with REIT funds due to the lack of available cash flow for distribution to unit holders during the development and lease-up periods. However, the appeal of these projects on a very limited basis increases if the development is coupled with a strong underlying existing income stream. For example, in the case of an expansion of an existing property. So most REITs have limited themselves to a relatively minor portion of their total assets being directed to development projects. There's about 16 REITs in the Canadian market sector today. There are 5 with diversified portfolios, 4 in the apartment and retirement sectors, 4 in the hotel industry, and 2 in the office and industrial sectors, and 1 in the retail sector. So if you're looking to get started in investing in real estate without the major headaches of owning property and purchasing property, REIT is a great way to go. If you want to learn more, feel free to contact me at 778-678-9815 or by clicking the link below. That's all for today. Dustin Miller, Fair Real.